Record in progress.
Perfect. Thank you so much, Carmen. It's exciting to be here. Really just grateful for everything, for you, Carmen, your production and your team, but grateful for just this partnership that we have between F&G and Experior. Like Carmen said, please do not hesitate to reach out to me or Tom. I'll make sure I give you both of our contact information here shortly, but we are serious. Like Carmen said, we're serious about growing and the growth we've seen from Experior and this partnership. Our business with Experior from 2023 to 2024 more than doubled, just to give you an idea of what Experior is doing, how amazing this partnership is. A lot of people are taking notice and writing a lot of F&G. If you're not on board, excited to kind of just introduce you to what F&G has to offer in our portfolio here today and go through some of those things Carmen was talking about. So just genuinely grateful because I love what I get to do here in my role. And without the agents, without you all, my role doesn't really exist. So I'm extremely grateful, here to help, and excited to work with you all. So first thing I want to go over is just what's new to F&G. So I got a couple things. The first one, though, is instant approval. And we've always had exam-free underwriting on our indexed universal life policies, but the instant approval is going to be a big win to get a lot of those cases issued even faster. So as of right now, you submit a case. If the client is 60 or younger, death benefits $1 million or less, it does not go through the paramed. Typically, the underwriter's looking at it within about 3 days, and then the requirements could go from there, or the case could go right to issue. So with this instant approval, we now have the ability for certain cases for healthier clients to go get approved and go straight to the issue team as soon as you submit it. So that's really exciting. To start off 2025, all of your exam-free business qualifies for the instant approval. To start off the year, it's going to be your healthiest clients. And as we go throughout 2025, we're going to start to open that up a little bit, start to take clients that may have some more pre-existing health conditions or some medications on their history that would typically qualify them for standard. We're going to start opening that up a little bit more. We wanted to go about this the right way, because if we start instant approving clients, we don't want that to limit who can qualify. Like, we don't want there to be more declines on cases, and we don't want the quality of the product to suffer. So that's the big win, is instant approvals rolling out. Right now, you'll see it on your healthiest clients, but our goal by the end of this year is to get to the point where about half of all the exam-free cases we submit are getting instant approved. So that's going to be a big win. And we're already starting to see some cases get pushed through and some big wins there. And we'll just start to see more and more as the year goes on. So that's the biggest exciting thing coming to F&G that's new. And I've got another one that I'm going to talk about here in just a second. But first, I want to go ahead and just share my screen real quick. Give me 1 second. And I just want to make sure, like I said, that you have our contact information. So Tom and I are your dedicated team here at F&G. Tom is a great friend and mentor of mine. I know he looks young, we both do, but he's been doing this 20 years. He knows his stuff, and we're here to support you. So whatever it is that we can do to help, take a picture of our cell numbers there and our emails, and reach out to us. If I don't talk to you again until the next training Carmen invites me on, then I haven't done my job. I want to have that relationship, partnership. Keep me in the loop. Let me know what I can do to help with any of your pending business, product questions you have, illustrations, etc. Now, with that being said, I'm only one person. Tom's only one person. So we're really good about getting back to you. We may not be available the second that you reach out to us. And that's where you can utilize the 800 number that's on the left side of the screen. And that's for our life sales desk. We actually have a team of 7 internal wholesalers, and their whole job is to be available for you throughout the day. So they answer 80% of the calls they get within a minute or less. They're really good at being available. They're really knowledgeable. So that's a great resource to have if you're sitting for a client and need somebody to answer right away to maybe help you tweak or run an illustration, stuck on an e-application, have a question, or just general product questions that you may have and you just need that immediate support. You can also call that phone number for risk assessments. So if you have a client that maybe has diabetic history or whatever, something in their medical history, legal history, driving history, maybe they're a non-US citizen and you just want to see would they qualify for an F&G IUL. If you call that 800 number and ask for a risk assessment, our team will patch in an underwriter. We have underwriters on standby waiting to talk to you and go over those things. So that's a great resource to have, along with my cell and email and Tom's information as well. So the next thing I want to show you, this is what's big and new to F&G. And this is the trip that we are hosting here at F&G. Excited to announce this. Actually, the qualifying for this just started 3 days ago on the 1st of February. 1st of February through the end of June, we're going to be taking 13 agents and a guest to the Montage in Park City, Utah. Really exciting. This is the very first time F&G's been doing this exclusively for Experior. So this is a really big win. Speaks to the growth Experior has, you have to do a good amount of production to get something like this hosted by the carrier. So speaks to what we believe in with Experior, but also the more growth we see, the cooler and more fun the trips get. So this is going to be the first of many. That's the exciting part. And my initial reaction is Utah. What in the world is going on in Utah? But some of these pictures of the resort I've seen are absolutely gorgeous. Cannot wait. A lot of F&G leadership will be there. Myself will be there. Tom will be there. So we could not be more excited about this. If you want to be a part of this, let me know, and I can and we can help you make sure you qualify. But it's going to be the top 6 writing agents, top 5 executive directors and their total production, and then a couple executive picks awarded to top producers as well, kind of a discretionary. So we're really excited about this. Just going to be a lot of fun. And again, would love to see you there. Let me know what I can do to help. Carmen, you going to be on this trip? I don't know if you're still walking around or listening. I know Carmen, based on her production last year, would have been right in the middle of the running for this.
Yep, I'm still here, just still walking. Oh, most definitely. I saw the pictures. Yeah, I've never been to Utah, but hey, any trip I can win, right?
Exactly.
It's all about the experience.
Absolutely. We're really excited about that. So that's what's new to F&G. You got the instant approval. We got this trip. There's another product update I'll mention, but I want to get a little further into our call here today before I introduce that. So next, I want to just go over some of the product highlights, and then we're going to jump over to illustrations, and we can go through some of those questions that Carmen brought up at the beginning. But why F&G for your IUL business? And I imagine many of the agents on this call are familiar with F&G. If you didn't know, all we do on the life side of our business is indexed universal life insurance, IULs. What is an IUL? If you're newly licensed, I'm sure many of you are familiar, but an IUL is essentially a permanent life insurance policy that is very flexible. We can customize the case to fit our client's needs, whether the client needs a higher death benefit, or maybe the client wants more cash value growth in their policy, or a balance of both. We can customize an illustration to fit the needs of the client. The cash value growth mirrors the performance of an index fund. And the most popular index fund in the IUL market is the S&P 500, for example. Then when you go to take money out of your IUL policy, the tax treatment of that money you take out is very similar to a Roth IRA. So that money will be income tax free when you go to take money out of the cash value growth. And then the cash value in these index funds grows at a really high level because there's something called downside protection. So in a negative year in the market, your money is not going to get negative interest applied. There's a floor of 0.25% positive growth no matter how poorly the market performs that year, and that leads to higher annual average returns over time. So that's my elevator pitch on what an IUL is. If you want to steal that and use that, because clients are never going to heard of an IUL, simple way there to kind of explain to a client so they understand what you're about to show them. Now, to me, the illustration looks fantastic with F&G IULs. We can look at an illustration and say, yes, I want to see that cash growth. That looks incredible. But if we can, in a couple simple steps, explain to clients why that cash value is growing so well, it helps them understand what they're looking at a little bit better. And in my experience, more likely to move forward. So there's 2 big things that make F&G IULs unique. and really show the value of the policy. The first is the product, obviously the performance of these indexes and how the cash value grows. And you see on this slide, we have diversification. We have quite a few options that you can have your money grow based on the performance of these indexes. The 20-year average on all of these index options is anywhere between 8 and 11%. So that's fantastic. But here's the story you want to tell with Morgan Stanley. That is our main index option that's had the best returns historically and has the best story. That S&P 500 index that I told you about that every IUL has. Every IUL has an S&P and it's always capped pretty much in every scenario. And what a cap means is that's a ceiling. So if there's a cap rate on an S&P index of 10% and the market does 15%, for example, your clients are capped at the 10% cap rate. And that's the trade-off for having the downside protection and having a floor. So in most scenarios, people are totally fine with that. What F&G did is put this Morgan Stanley index together, which is actually a combination of that same S&P 500 index and the NASDAQ 100. Whichever of those two, S&P 500, NASDAQ 100, has a better performing year that particular year, that makes up 2/3 of the Morgan Stanley. And then the other index makes up the remaining 1/3. So we have two equity indexes that are a lot of upside inside Morgan Stanley. When we created this Morgan Stanley index on the policy, it allowed us to offer that index completely uncapped to your clients. So S&P 500, that is the staple of the IUL industry, has a cap rate. Our cap rate was 12% on the S&P, and that's one of the highest ones in the market. With this Morgan Stanley, it's the same index with a little bit of NASDAQ mixed in. Now we're able to offer it uncapped, and now we're getting 20-year historical returns that are averaging 11.32%. So it's like if you go to Las Vegas and you can play the slot machine all day, and I told you every time you lose, you don't lose your money. If you lose that spin, you don't lose your money. There's a floor. We're not going to take money from you. But if you win, not only do you get your winnings, but the winnings are not capped whatsoever. You would play the slot machine all day, right? That's essentially kind of how the Morgan Stanley IUL works and that index and how that money grows. So that's a really cool story, easy to explain to a client why they're seeing such good growth in that index. We're taking away the negative years, not limited on our upside. That's rare to find and a big win. Now, the second big piece of this is when we go to take money out of the IUL. How does that work exactly? With F&G, we have a fully participating loan option. With this loan, that money that you take out of your policy will continue to participate in the growth of the Morgan Stanley or S&P or BlackRock, whatever index we have selected. Like I talked about, those indexes are returning between 8 and 11% historically, with Morgan Stanley on the high end of that. We charge a maximum loan charge of 5% for you to use that option and have the money still grow inside the policy. So simple math here. Let's take the low end of those returns. Let's say the market does 8% after you take money out of the policy. What's the difference between 8% and the 5% that we charge for that loan? Yeah, Carmen's doing it 3%. So in that scenario, market performs at 8%. We use the participating loan option. Your client is netting a 3% net gain in that scenario on money they've already taken out of the policy. So we can share a story where we get great returns because of the downside protection and not limiting our upside. And then when you go to take money out of the policy, you have a fantastic opportunity for positive arbitrage and positive net gain on your borrowed money. So you can take $100,000 out of your policy, spend that money, and you're still getting growth on that money in the policy. That is an extremely cool concept that you can't find in most vehicles, but in IUL you can. So if we're looking to explain to a client the value of an IUL, those are the two big things right there. We get great growth over time, and we'll get growth on our money when we take it out still. Plus, there's tax advantages that come with this. Like I said earlier, those loans are tax-free. And then living benefits is another big benefit of this policy, right? We got the critical, terminal, and chronic illness riders, plus the death benefit that comes with that. Because the clients are going to ask, or wonder maybe in the back of their head, why is it smart for me to put my money into an IUL? Because there are charges on an IUL. There is a cost to the insurance, right? Why is my money going to grow better in an IUL than it is in another vehicle? That right there is why. We get great returns in Morgan Stanley over time. And then when you take money out, it continues to work for you. Those are the two big things that really separate the value and make it worth those charges. The next slide I'm going to show you is exactly how this Morgan Stanley works. So you see on these, there's actually two Morgan Stanley options. Both are uncapped, like I said. One comes with a 110% par. So what that means is that is the amount, that is the percentage you get of what the Morgan Stanley does. Let me keep it simple. Whatever Morgan Stanley performs at, if you have a 110% par, you multiply that by 1.1. So if Morgan Stanley has a 10% return, multiply that 1.1 participation rate, that actually turns into 11%. Like a 10% return bumps up to 11 when you do that. 5% turns into 5.5. So we get even a small boost on top of what Morgan Stanley does. And then there's the secondary option where it's a little bit lower participation rate. However, there's a 1% bonus. So no matter how poorly the market performs that year, you're still going to get the bonus. So essentially what this does is it raises the floor. The floor on our index options is 0.25%, but when you add that 1% bonus, we essentially raise the floor to 1.25. The higher participation rate option gives you more upside. The bonus option gives you a higher floor with more steady, consistent returns year to year. Both are fantastic options. You can't go wrong. Our illustration software defaults to the bonus option with 50% allocation and the other 50% going in BlackRock. So if you don't want to have all your eggs in one basket, which I think is a wise idea, then BlackRock is a good index to mix in. BlackRock is the opposite concept of Morgan Stanley. It's more steady and consistent returns. It's something we call volatility controlled, meaning it's not going to be volatility as how much up and down it goes year to year. Sorry. So volatility controlled, that index is more steady and consistent returns. And we boost it up with a higher participation rate because that index on its own is not going to have a ton of upside. A lot of years where you see 4, 5, 6% returns, but that 1.6 multiplier with the 160 participation rate really helps boost that up to perform at a really high level inside the policy. I would focus on these index options right now. I would focus on Morgan Stanley and BlackRock. We do have the S&P option along with the Barclays, but really because Morgan Stanley is uncapped and BlackRock is very similar to Barclays, but it has a little more upside the way it's structured, I would be focusing on those. But I did want to just show you these real quick because you will see these index options on the e-application and on the illustration software. But for those reasons, I'm focusing on Morgan Stanley and BlackRock more so. And then just a couple last product details here. We can start a PathSetter application as young as 15 days old. So as soon as the baby's 2 weeks, we can submit an app. This is a fantastic fit for million-dollar baby concepts, juvenile IULs where we're trying to fund for college, things of that nature. It's a perfect fit. And we can go all the way up to age 80 with the paramed exam because, like I said, 60 is the cutoff for the client to qualify exam-free. There's also a persistency bonus. I talked about the bonus on Morgan Stanley and BlackRock and some of the index options. There's also a 0.25% persistency bonus that kicks in the 11th year of the policy and beyond as well. And then the last couple things I want to show you before we move on to couple illustrations, a couple of the target conversation Carmen had mentioned earlier, living benefits. It's really easy to take these for granted at times just because living benefits are included on pretty much every life insurance policy these days. But with these, they're included on the policy for free. So the living benefits are not affecting the cash value growth inside your policy. We offer the critical, terminal, chronic illness riders. With the critical and terminal, they're a one-time rider. You use it and then they're done on the policy. The one difference with the chronic illness rider is that one you can accelerate multiple times. So you can take a little bit less per year, but you have the ability to stretch that out. It's up to 25% of the death benefit over 4+ years. You can take that until you've exhausted the full death benefit if you can't perform 2 of the 6 activities of daily living or have any severe cognitive impairment. Your client does not need to be a standard or preferred health class to qualify for these riders either. That's another great thing. They can be a substandard table 3, substandard table 4, and these valuable living benefits will still be included on the policy. And then finally, from an underwriting standpoint, we do a lot of business with non-US citizens. Your client does not need to have a social security number. We can take their ITIN number. Even if they don't have either of those, we can still approve the policy potentially with an IRS form. So if you have non-US citizens, take a look at F&G. We have pretty guidelines that are pretty easy to follow and understand and are pretty reasonable to get non-US citizens approved. The product is exactly the same. The biggest difference is from a underwriting standpoint, exam free is available up to 300,000 for non-US citizens. That's the one difference. Otherwise, same product, same policy. And we do a lot of business in that space. Give me a call if you have a client that you think may be a good fit, or you're wondering if they're qualifying. Give me a call, give our risk assessment team a call, and we can help you with that. Like I said earlier, as of right now, underwriters are looking at the case you submit within 3 days or less if it's not instant approved. So if your client doesn't get instant approved, no worries. Doesn't mean they're going to get declined by any stretch. Still probably going to get approved. Goes to the underwriter. When the underwriter looks at it, if the underwriter doesn't have any questions, they'll send the case straight to issue. One thing the underwriter can do is request a phone interview. And this happens on about a third of our cases right now. And it just, the underwriter has a couple extra questions they need to ask the client just to feel comfortable approving the case. One way we can avoid some of these phone interviews is by potentially answering the underwriter's question with the info we're putting on the application. So the underwriter is going to see in the medical history the last 5 years of medications, diagnoses, and kind of the client's medical history there. If we know there's going to be something that comes up, if we know there was a medication taken 2 years ago, maybe they're taking it now, maybe they're not taking it anymore. Regardless, the underwriter will see it. If there's any diagnosis, any information you know the underwriter will see that you can give context to on the application, we can potentially address the underwriter's question or concern right up front. Tell the story ourselves as the agent, not let the underwriter kind of defer their own story. That's going to help limit a lot of phone interviews, because then the underwriter doesn't need to ask the client anything. We've already answered that question on the app. So being thorough on the application, taking that extra 2 to 5 minutes could potentially help get a lot of cases approved faster. So that's one tip I have from an underwriting standpoint, but we approve 90% of our cases at standard or preferred. And a lot of that remaining 10% are not necessarily getting declined. They're still getting a substandard table rating offer of some kind. So I like those numbers. They're really strong. 90% is a really strong standard or preferred rate. Speaks to the consistency of our underwriting process and the job our agents are doing currently at field underwriting. So thank you for that. Before I keep going, any questions on anything I've gone over thus far? That sounds good.
I think we're good. You're doing great.
Thank you, Dominic. I appreciate it. All right, I'm just going to pull up. I want to show you just a couple illustrations real quick and talk about how we get paid on these, how that works, and just show kind of our most common case designs we have here at F&G. Go ahead and share my screen again. If you're new to our illustration software, my goal here today is to show you how to run our most common case designs in just a couple easy steps. And if you have used our software, maybe I can introduce you to a couple things here that may be helpful tips for you. So first things first, I want to start with our bread and butter. This is our most common case design that we get here at F&G, and we call it max accumulation and income. This is a great fit for anyone that's an adult that's looking to supplement retirement income, not looking for the highest death benefit. So minimal death benefit, we're overfunding the case. Also works fantastic on juveniles. It's going to be the same concept that we would run on a juvenile. So I'm just going to pick an adult at 30 years old here, just to give you an idea. And this is going to be our Path Setter product. So Path Setter is our flagship IUL product. Main one you're going to use when it comes to cash value accumulation. Everlast I will hit on next, but that's more of our death benefit focused IUL product. And we've had some enhancements to that that I'll hit on here before we wrap up. But Path Setter is the product you're going to use. That's the one that has the Morgan Stanley index, and that's the one that's going to build the most cash value inside the policy. When you run these illustrations, this top part is the client information, pretty straightforward. The one thing I'll say on this is I would always apply for my client at standard. And the reason is we are going to underwrite best class regardless. So if your client qualifies for preferred, even if you apply at standard, we will still bump them up automatically to the better rating if they qualify. The underwriter doesn't even look at the rating you applied at until they have their own decision. And then they're going to give you whatever their decision is. So applying at standard is under promise, over deliver, much easier concept there when you're going over with your clients. Now, the whole thing starts with what are we solving for? What are we trying to accomplish in this case design? You'll see there's quite a few options, right? And like I talked about, max accumulation and income is what this product's known for. So much, in fact, we actually created a shortcut. If you click this Run Quick Solve box, it's going to pre-fill all of the optimal settings for that max accumulation and income design. So if you're already using this, you know how easy it is. I click on this box and I scroll down to the premium section and I put in the modal amount of premium I want to illustrate. So if I'm showing a $300 a month illustration, I click on the box. For Quick Solve, I come down, I put in the $300 a month. That's it. So that's an incredibly easy way to run our most common case design. With this max accumulation solve, it does give a little bit of a buffer so your client can actually go above that $300 a month in the future. And it's going to pay the premium to age 65 and then show income after that. So if you want to make any customizations, we can do that outside the quick solve. But again, if you got new agents on your team or you're newer yourself with F&G, this is a great foolproof way to run an illustration that's going to show great cash value for your client. Now, once the illustration pulls up, you're going to want to start on page 11. This is going to be that tabular detail section you're going to go over with your clients. And there's 3 columns on this illustration. Each column is going to show the account value growth, the surrender value growth, and the death benefit. The difference between the account value and the surrender value is the surrender value is what your client actually has access to. The biggest difference is in the first 15 years, there's those surrender charges that you typically see on a policy. So that's the difference between those two numbers early on in the contract, is the surrender charges are the difference there between the account value and surrender value. Now, this first column on our left, guaranteed assumptions, 0.25% interest. That is something we are legally required to put on our illustrations. It is essentially assuming that the market is a negative market every single year for the rest of his life. This is obviously not a realistic scenario. The market always bounces back. This isn't something we really need to be too concerned with, more something we're legally required to put on the illustration. So if you see on the guaranteed assumptions that the cash value runs out eventually, do not worry about that. That is completely normal and not realistic for that to ever play out. The middle column is showing our fixed account growth. So I talked a lot about Morgan Stanley and BlackRock. The fixed account locks in a 4.75% return each. Right now it's at 4.75 for the year. So if your client wants to just get guaranteed growth for that year, we can go with the fixed account. That's what's being shown in the middle column. You give up a lot of upside when you put all of your allocation in the fixed account. Over time, Morgan Stanley, BlackRock should well outperform that number. So that's not something we really want to focus on either, but that's what's being shown in that middle column. Excuse me. The far right is really where we want to be putting our focus on. That is the blend of the Morgan Stanley and the BlackRock that the illustration software defaults to. This is not a best case scenario. I think it's easy to look when you see three options. It's easy to look and say, okay, worst case scenario, middle case, best case scenario. While those numbers on the far right are not guaranteed, it's dependent on the performance of those indexes. We could, if the market's down, we may get less than what we're seeing there. But if the market performs well, we're just as, if not more likely to potentially get more growth over time as we do our best to illustrate these indexes at a pretty conservative rate, especially relative to how they've performed historically. So on this illustration, you'll see the cash growth over time. An IUL is not a product where you're going to see massive returns in the first handful of years. It typically is more longer term where you start to see the serious cash growth and the break-even point, where what we've put in is what the client has in cash value is typically around year 8 or 9 when you design it this way. That's because of the charges at the beginning of the policy and the cost of the insurance. Like we talked about earlier, the indexes are going to perform at an elite rate over time. You're getting greater returns here than you can get in a lot of other vehicles. So it takes a little bit of time for the growth of those indexes to offset the charges and for you to start seeing great returns. But over time, you see the value. And when we look 20, 30 years into this, we really start to see that cash value pick up. This is an increasing death benefit, so the death benefit's going to grow with the cash value. And by the time we get to age 65, you see in this design where at age 65, we peaked at 461,000 of cash value in the policy. And we're able to turn that into an income stream. If we look on the left-hand side, we see the premium stopping at age 65 and a tax-free income stream of almost 50,000 a year. So that's our bread and butter case design right there, building that cash value, turning that into a tax-free income stream. We see where the illustration software totals up what we've paid into the policy and what we've taken out of tax-free income, and there's still a death benefit even remaining at that point as well. And if you scroll down, you'll see that this case continues to run all the way through age 120. Now,
Blake, how old is this person again?
30 years old.
30. Okay.
Yeah,
Oh,
30-year-old male, $300 a month.
300 a month. Okay. Gotcha.
Now, the next piece of this is, how are you getting paid as the agent? What is the target premium? How does that work? So the target premium will be found on page 2 of the illustration, right in the middle. So the target on this case is $1,275. Pardon my terrible circle there in bad handwriting. So the way the target premium is calculated, it's directly correlated with the initial death benefit. The higher the initial death benefit, the higher the target premium is going to be, and vice versa. A lower death benefit, you're going to get a lower target. On a max accumulation or quick solve illustration, you're going to get a target that is lower than what the client's paying, potentially by a decent bit. This is great for the client, but we need to just be aware, because I know in my experience, I've been there, where you sell a policy for $300 a month and you get paid like it's $100. If you don't know that ahead of time, that's going to hurt when the commissions come. If you understand that's coming, it's more palatable. We can also tweak the case to get a target that is more palatable for you if that is important to you. We got to do what's best for the client, but also understand we need to make a living as agents and need to make sure this is worth the time we're putting in. So with this case, you're getting paid like the annual premium. So if this is a term policy and you're calculating your commissions on a term policy, the annual premium that you're using for that calculation would be $1,275 in this case, even though the client's paying $3,600. So that's how it works when we overfund a case, max accumulation, lower death benefit, you're going to get a lower target. Now, all we need to do if we want to play with that target, if we want to adjust that, it's pretty easy. You see on this policy, the death benefit is $171,000 is the initial death benefit. So what I can do, this quick solve is going to solve for the death benefit for me, right? See how it says solve for face? So it's solving for that low death benefit. If I don't use the quick solve and I just solve for something called income stream, This is just going to add on the income at the end. So you see 65 for 25 years through age 90, but now I can manually specify what I want the death benefit to be. So 171,000 gave me a $1,200 target. Maybe either I just want the target a little bit higher, or maybe I just know the client needs more life insurance, right? Maybe they're underinsured. I can go to this initial face amount box and I can put a $300,000 death benefit, or 350, 400, 250, whatever. I can raise that, and that will raise the target by a similar percentage. If I double the face amount, the target will double as well. So going from 171,000 to 300,000 death benefit, we should see the target pick up from about 1,200 to getting over 2,000. Still overfunded for the client, but maybe this is a better compromise. So I'm not here to judge. It's up to you how you want to run these, just providing the tools here on how you adjust the face amount. And see, now we got a target premium that's 2,200. So if I go up to 400,000, 500,000, I'll get the target even higher. With the target premium on commissions on the Path Setter product, you don't really ever need to have the client paying less than the target. If the client's paying 300 a month or 3,600 a year, but the target's 4,000, you're going to get paid on the lower of the two. So if the client, there's no real benefit on Path Setter to the client paying less than target. I would always have them pay target or more. Was that what you were, any more you think needs to be mentioned on that, Carmen, or any other questions in regards to that target conversation?
No, that's great. I mean, if anybody else has any.
I have a question.
Yeah. Hey,
Does
Frank.
does it affect the target too? Like I noticed in the quick solve on these, the death benefit was B to A. Does the quick solve ever do A alone, or does that affect anything in the target?
Great question. The quick solve will not. The quick solve locks you into the B to A. Excuse me.
Okay.
So with the you are correct though that correlates to a degree. If you do an option B death benefit increasing, or B to A, same thing. The benefit is we can get the death benefit a lot lower. That's why we do the initial death benefit, or the increasing death benefit, is because the initial face amount is a lot lower for the same premium. So if I can run though the same max acumen income illustration with an option A level death benefit. So this is not the quick solve, but this is where I can make some extra customizations, right? It's still 300 a month, paying to age 65. So if my client says, well, I want to see an illustration where I pay to 68 or 62 or 70, here's where you can adjust that. Same if I scroll down here to the income start age. But now I can run it if I want to add an option A level death benefit. And we'll see that it's going to start at a much higher face amount, which gives you a higher target. The trade-off is the cash value growth and the income will be a little bit less because of the higher cost of insurance early in the policy. But this is another way to set this up that's a good compromise to get good target and still really good cash value growth for the client. And if they need a higher death benefit to start the policy, then that could still be very beneficial. So now you see we're at 435,000. That brings the target premium up to 3237. And we still get good cash growth, but now we're looking at about 40,800 on the income stream, where the previous one was 49,000. So that's kind of the difference there between those two. Is that helpful, Frank?
Yes, it is. Thank you.
Perfect. Absolutely.
Hey, Blake,
yeah.
when I just looked away just for a quick second, did you did you only just change it to level A? That's all you did?
Yeah, I can't do I did it in the max acumen income solve. Can't do that with the quick solve. But yes, that's the only difference between those two case designs.
Okay. Can you do one more case design where you showed me, right? Because I'm always switching some stuff around, and you told me that I could run the illustration at target.
Yes.
Right. I can have them actually put in a premium and then run it at target. Can you show the team how to do that real quick?
Absolutely. It's the second solve below max acumen income, target face and income. So this gives that same case design. It'll face amount that matches up what the client's paying versus the target premium. Those numbers will be exactly the same. And a target solve is a great way to provide balance with death benefit and cash growth. We're kind of putting equal emphasis on both. So when I select the target facing income, it looks very similar. This pop-up box looks very similar to the max accumulation and income box that pops up. I put in the premium, how long I want to pay it for. So you can see how you can, if you use these solves, it's really only 2 or 3 steps. It's the solve, putting in the premium, and then maybe what you want the death benefit option to be. Do we want it to be increasing B to A or just stay level? And do we want to customize maybe when we start the income? With a target face and income solve, you can run this option A and just keep that level. It'll be a good way to still get a good amount of income on the illustration for your client. So this will give us that target of 3,600 and see what kind of cash growth we get on that.
Yeah, because at the death benefit, can you still hear me? Yeah, at the death benefit A, we lost 9 grand a year. Right, so we want to see what the cash looks like if we just run it at target. And then again, what we're doing here is we're giving the client still a higher death benefit, but we're giving them a how did you explain it, Blake?
Yeah, we're a balance between the
Yeah.
cash value and death benefit. Yeah, it's kind of the analogy I like to use. You know, on a playground, there's the seesaws where the heavier kid sits on one end and the other end goes up, and vice versa. That's kind of how IUL works a little bit. A target solve is equal emphasis. If one end of the seesaw is death benefit, one's cash growth. A target solve is kind of like both kids weigh the same, and that thing is just right in the middle. But then if we go more emphasis on higher cash value, lower death benefit, it kind of slides with the scale, right? So target is a great balance of both, where that max accumulation design I had is like death benefits way down, but cash value is a little bit higher. So with this one, I think we still get an income stream. Yeah, still 38,500, and it's almost a 400K death benefit.
So it's a little, so the cash is a little bit lower. So let's look at the commission. Let's look at the target amount. Because in the other one, when we had it just level, it was like 30, what was it, 3,200?
Yeah, exactly. Now it's right at 3,600.
You see that, Franklin? You see that, guy?
Yes, that's yeah.
So this is another way to where how can I explain? If the client really doesn't have any life insurance at all, and they're in their 30s and they're in their 40s, and they really don't want to shop around for any more life insurance, and they've got a kid and they've got a wife, or maybe it's just them, maybe they just have a wife and they're good and they don't want any more insurance, and they just want a really heavily valued IUL. That's a good way to run it, especially if they're healthy and they're young enough to dump more money in, and you still get a decent commission. Whereas just running it all level and giving them a crazy high death benefit, you're able to, like Blake said, kind of like even it out. Did I right?
You nailed it. Yeah. At the end of the day, we sell life insurance. So I'm never going to feel bad about giving someone more death benefit. That's what we do and why we're in this, right?
Right. So we went through, so guys, we just walked through like 3 different, we walked through 3 different case designs.
Yep.
Thanks, Blake.
Absolutely. Frank, do you have any other questions on that before? I know Amy has a question as well.
Just a quick one on, if let's say like you started at, you use 300 here. If the client says, hey, I want to get into this, I have the 300, but I know my income is going to grow here based on what they do business wise in another year or so, and they want to come in and add more premium. How does that affect both the death benefit and the target?
Great question.
If that's possible.
Yeah, great question. So the death benefit, it doesn't really affect the target. The target is set based on the death benefit. So if the client overfunds in the future, the target's not affected. It doesn't really affect your commissions too much. But if the client wants to do that, we want to give them the ability to do so, obviously, right? So where you go to determine that is it's actually right above the target premium. It's this guideline level premium number. So on this case, the client can go up to 620. $6,200, $63 a year. That's what they can average per year before we would run into any errors with the MEC guidelines.
Next guideline. Okay. Yeah. And that's, yeah. That was
So,
my next portion.
Great question,
When does it come MEC? Yeah.
yeah, great question. And then the last thing I'll show you on that is if we do the exact same illustration, but instead of the option A level death benefit, we do an increasing with the B to A. And with the B to A, this change age where we switch it from B to A is always the same age that we stop paying premium. That's how I would always do that. So if we stop paying premium at 65, we do death benefit B to A at 65. And if we never stop paying premium on an illustration, then you just do straight option B and never switch it. So if you're familiar,
okay.
do that.
Yeah.
Hopefully makes sense.
Yes, it does.
Okay. But when you do an option B to start, look at how much more room the client has to put in premium. This number is going to be significantly higher. Now they have 19,000 a year that they could put in. So the option B really opens up. You can get a lot more premium into the same death benefit with the option B. And this will still start at that same 483,000 number. So if they're never going to get to that point, option A is fine. But if they do say, hey, maybe they get annual bonuses randomly of like 10,000 and they want to just be able to dump that in whenever, we want to give them the room to do so, and target solve with option B is a great way to allow them to do that.
Awesome.
Great questions. Thank you, Frank. Amy, you got something for me?
Amy.
Oh, yes. How you doing?
I'm
I'm here. My question is, as far as the insurance part of it, are the riders of the family or whatever, is that extra cost to add them, or is it just insurance on the person with the IUL?
It would just be on the insured. There are a couple riders further down here. I can go to additional benefits, and there is a children's term rider, for example, where we can get the kids covered up to a max of 25,000. It will cost something. That will come out of the cash growth. It costs a handful of dollars a month. There is a spouse term rider as well, where you can get the spouse covered on the policy. But Amy, if I'm being honest, in an ideal situation, we would be getting individual policies on anyone else in the family that wants one. The spouse term rider can be helpful if the budget is tight and we need to get them both approved in a little bit of a tighter budget. But with the spouse term rider, we get the spouse is covered, whoever the primary insured is. If they pass away first, we pay out a death claim, riders go away. If we pay out a death or living benefits claim, even on the primary insured. So then the spouse term rider could lose their coverage. You see what I'm saying? If the spouse term rider dies first, it's okay. The policy's still active. We pay out the rider, but the policy's still active. But then when you're setting it up, you're kind of guessing like who's going to die first. And that's just not practical, right? Like we don't want to be doing that. Plus the spouse rider does not come with living benefits. So if the budget's really tight, you could look at it. In most scenarios, I would be getting a policy on both spouses.
Okay, now
Blake,
the reason I asked is because I do know somebody who the breadwinner is the wife and the husband is disabled, but she still wants some kind of coverage for them in case something happens to her, that she would be able to get some of the death, he would be able to get some of the death benefit, but it's unlikely that he'll outlive her because he has some issues that it's very even hard for him to even get covered by himself.
But
So how would you?
The spouse term rider is going to go through the same underwriting as the primary insured. It's not a way to get somebody covered that's uninsurable. So if we can get him approved, great. It might be like if he needs a little bit less coverage, but at the same time, if he can get approved for the spouse term rider, he would also be able to get approved for his own policy.
So in that situation, since he's because I'm trying to do a life policy on him now, it's very hard to get him approved. So the death benefit in general if something happens to her, he would still be able to be the beneficiary on that policy for that, right?
It's
Without
absolutely
having him to actually to have a policy if he don't qualify.
correct. Yeah, that does not, these do not affect the beneficiaries whatsoever. The insured can pick, or the owner of the policy picks whoever they want for their beneficiaries. They don't have to have a policy with
Okay.
us or be covered.
All right, got it. Thank you.
Yeah, great question. Thank you.
Hey, Brick, this is Emma.
Hey.
Thank you for that information, especially that one for the spouse rider. I didn't have much information about that. You did mention that it goes the same underwriting, and you said if the primary dies first, it gets paid off and the spouse loses coverage, correct?
Correct, exactly.
If the spouse who was on the rider dies first, what happens?
Then the policy stays active. The primary insured would still be insured. The primary insured controls everything. As soon as we pay out a claim on the primary insured, policy's done. But if one of the riders gets paid out, the primary insured would not lose their coverage.
How much is paid on the spouse rider? I know the kids you said 2,500.
You can specify whatever amount you want for the spouse.
Oh,
As
okay.
low as 50,000 and as high as we can
Got
approve. Yeah, as long as high as the financials justify. But it's really not that much more. It's the same. It's really very similar if you just set up their own policy, which is why I just prefer to do that personally.
Thank
I have
you.
a quick
Appreciate it.
question.
Yeah.
You guys, stop going down the rabbit hole with these spousal riders, okay? We're not doing nothing to our spouses.
Mhm.
I have a quick question.
Go ahead.
This is Leroy. Can you hear me?
Yes, I can.
Okay. What is the can you write an IUL on someone who is over 60 but does not have a lot of money, probably $5,000, $10,000 to start? Can that be done?
Yeah.
And does it make sense to do? And does it make sense to do that?
That's the question. Yeah, we absolutely can. We can go up to age 80. Anyone over 60 needs to do a paramed, but we could get them approved. What was the premium amount you mentioned?
About 5,000.
5,000. Yeah. If it's a year or
And
just
for how long? And for how long would that go? Because would it even make sense to do an accumulation policy on that person at that age?
it would probably need to be more substantial premium. Probably not,
Okay.
because the minimum death benefit's 50K. So just funding 50K on someone in their 60s or 70s is not cheap, obviously. So if we
Right.
have substantial premium, and you need to typically fund it for at least 3 to 5 years. Like a single premium is not a good fit for an IUL. If they have 200,000 and they want to go 40,000 for 5 years or 50,000 for 4 years, that's a scenario that could work potentially really well.
An annuity might be better for that person, possibly.
Probably, yeah. And in a lot of those cases, probably depending on their goals. Yeah.
Okay, great. Thanks.
Yeah.
Appreciate it.
I would say typically pass setter's great up to age 50 for kind of those modest monthly premiums. And then over that, it would need to be like more substantial premium. Now, the last thing I can show you real quick is we actually have a death benefit focused IUL I mentioned earlier, which is Everlast. And this is incredibly easy to quote. I can show you in just a minute here. This would be someone who's a little bit older, maybe 45, 50 and up, but this one's more concept based. What are they looking for? This is a client who is looking for the highest death benefit at the lowest premium. They're not going to build a lot of cash value. The goal is to, again, just get the most death benefit at the most affordable premium. So if I got a 50-year-old male that's looking for 200,000 of permanent coverage, for example.
I was just about to ask Blake, what's the max on this, on the Everlast?
Minimum is 100,000 for right now. The maximum is same as previously, up to $1 million exam free. We can go higher if needed.
Oh,
if it qualifies, yeah. So it's kind of final expense on steroids is a great way to put it, right? And all I got to do to quote this is solve for the premium. So I put in the death benefit and I solve for the premium. You don't change anything on this box that pops up here. And it's basically just like quoting life insurance. So now if I go to run this, we'll get a pretty reasonable premium. And this, we've had some enhancements to the rates on this policy. We've always had Everlast, but it's a lot more competitive today than it was previously. So if you run this relative to some other competitors that do a similar thing, you're going to get a quote that's extremely competitive. So 2608 a year, which comes out to 217 a month. We can get 200,000 for a 50-year-old male at 217 a month, and that's essentially the lowest premium to get this policy just to run through maturity is what that solved for. So yeah, that goes all the way through age 120. So that's the Everlast product. And now we've always had the cash accumulation path setter. You're still going to put your clients looking for cash growth in path setter. Do not put clients that you typically would put in path setter and Everlast. But now you have maybe a product for clients who are just looking for permanent death benefit at a low affordable premium. And that will still come with the living benefits, the Everlast does.
Yep, I've used that.
Does that I kind of lost my train of thought, but does that include, or if you look at an older person with that, do they have to go through a paramed for that, or is it is there a certain amount up to where they don't or they do have to go through a paramed?
Same as path setter, 0 to 60 age and through a $1 million face amount is no paramed exam and eligible for the instant approval.
But for Everlast,
Exactly. It's the same 0 to 60.
oh, it's the same. Okay.
It's exact same for both products.
Super. Thank you.
Yeah, good question. Thank you.
So, and the Everest is intended for protection, so it
Exactly.
doesn't
Yeah.
come
Oh,
with
sorry.
living benefits, right?
So it will still have the living benefits on there.
Oh, okay.
Awesome.
Thanks.
Absolutely.
Well, guys, that's it. If you guys don't have any more questions, Blake, this was awesome. I'm so glad that I got this on record. It's awesome. Thank you so much for spending your morning with us.
Hey, who am I going to see in Dallas in May at the convention? Am I going to see everyone there? Yeah,
Yes.
I love it.
Yes,
I'm
yes,
excited.
yes,
I'm excited. I think
Yes.
that's when we met, Carmen. We met in Toronto last year. That's the first time we met at the one up there. Now we get a home
Yeah.
game this year. We get them coming to the US. Should be a lot of fun.
I'm telling you, the US is taking over. You know, that's just how we do anyway, you know.
Yeah, it's very what we've seen.
I told Jamie, he's like, Carmen, you're right. I said, bro, we're not
Hey, Mike.
with Canada. We don't have time to be fooling around with Toronto. Toronto can't handle it, the US.
Correct.
Handle it.
Exactly.
No, it's,
Exactly.
plus
Oh man.
it's too expensive anyway.
I have something for Al from
Okay.
Alex.
All right, so I will go ahead and end the recording.